What is up, you guys? Thanks so much for joining me today. It's your boy, the Finance Bro. And in this video, we're going to be taking a look at shares of three companies that are Microsoft, Alphabet, and Uber that I personally believe are still good buys for the month of August 2026. We will take a look at a few valuation metrics and a few points as to why I personally believe that these three companies are still a good buy today. As always, this video is not investment or financial advice and is solely for entertainment purposes. So we'll dive right in here to Uber, the first company.
Oh, it's on the book, my man. Uber, Uber is going to be like ISIS, my friend. Uber is ISIS. You know what ISIS mean? Uber is ISIS, my.
No, Uber is certainly not ISIS, but Uber is a very well-run company. A few key items I want to point our attention to. You can see earnings per share next year, fiscal year 2026, are coming down from $4.73 a share to $3.31 a share, and creeping back up in 2027 to $4.45 a share. I do believe that management and analysts are being conservative in their estimates of earnings per share for Uber. They are heavily investing in diversifying their revenue streams, being an autonomous vehicle aggregator, which we will touch on later on in the video. But we're seeing sales growth over the past 12 months for Uber of 16.7%. Uber is often compared to Lyft. It's really nearest competitor in the ride-sharing service. Waymo is creeping up there. It is the autonomous driving service of Alphabet, which we'll touch on again later on in this video. But just as a comparison, when we compare just the daily rides of Waymo compared to Uber, Uber does 600 times the amount of rides per day that Waymo does. You can see that dominance and really the moat that Uber has. We can see some profitability metrics, gross margins of 35.4%, very healthy, trending in the right direction. And what we'd like to see is from that gross to net margin, you are seeing that compression to 17.3%. But when we look at that trend over the past 6 years, you are seeing that trend of Uber's net margin going from significantly negative, almost negative 30% at one point, to positive 17.3% over a 6-year time frame. That does indicate the company still has room to grow. And if they're able to be financially disciplined and improve operational efficiencies, they should see margins expand in the coming quarters and years. And with the heavy amount of investment that Uber is doing, you are still seeing that return on equity, total capital, which we'll all touch on later on in this video, trending upwards really over the past 8 years and over the past 12 months, return on equity of 38.4%. Very prudent allocators of capital within their own business. And when we look at some valuation metrics, 17.2 on a trailing PE, on a forward PE basis, 19.5, even the price of sales of 2.9 is a very cheap valuation for a company that still has that growth. And I want to mention towards the end of July and really to the lows of this year of 2026, Uber reached nearly $66 a share, trading currently at the time of this video of $70.03 per share. That is a significant rally. And even after that significant rally, shares are still very cheap and discounted to their true intrinsic value. And when we look at the price targets, there are 46 analysts who cover Uber shares. The risk reward is very healthy. On average of the 46 analysts, there is a $102.37 price target, implying almost a 32% upside. When we look at the downside, trading at $70 a share, the biggest bear has shares declining to that value, meaning a 10% decline. Again, shares were trading at $66 at one point towards the latter half of July 2026. Even the biggest bear had shares above their 52-week low. And we see the biggest bull in this case having shares at $150 per share, implying an over 90% upside. So you see that risk reward, I personally believe, in favor for investors to start allocating some capital. And you see that blue line up top compared to that dotted line, which is the analyst price target. Shares are trading significantly below where the smart money personally believes the true intrinsic value of Uber should be. We have seen some revisions downward. Uber did just report last week. There is a lag in terms of some of these 46 analysts revising up or down, depending on their outlook and their firm's outlook after the most recent earnings. So let's keep an eye on analyst price targets. That should come to light in the coming days and weeks. And I want to compare Uber to, like I said, Lyft, its closest competitor. DoorDash is getting a lot of attention recently as well. When we look at how these shares are trading relative to the peers, Uber is trading at a very significant discount. Look at that on the forward PE basis. Uber, like I said before, is at a 19.5. Lyft is at a 20.7. DoorDash is at a 55.5. I mean, just look at it in your day-to-day lives. When you need to have a ride-sharing experience, which company do you gravitate towards? Most likely 8 to 9 times out of 10, Uber is winning that business. And hey guys, baddies don't take Lyft, they take Uber. When we look at that price of sales as well, Lyft is trading at a 1, Uber is at a 2.9, and DoorDash is at a 5.8. So DoorDash is looking the most expensive out of the group. Not entirely sure how people can really justify entering DoorDash with a forward PE of 55.5, but hey, to each their own. Right now, Uber, relative to the group, is trading at a very fair value. And I want to take a look at a few profitability ratios. You can see very good trends in gross margins. That operating margin, pre-tax margin, and net margin is very healthy, moving up to the right, trending in the right direction. You can see in December of 2020, net margins of negative almost 61%. Compare that to fiscal year end of 2025 of 19.3% net margins. Very healthy to see. Operationally becoming more efficient. You can see that through the revenue per employee and net income per employee continuing to rise, those margins continuing to expand as Uber continues to expand in the lower cost regions. For labor, for example, we should continue to see margins expand. And also Uber really gravitating towards a subscription service, which is very high margin. Having that autonomous vehicle service as well should continue to expand margins. Let's see how that affects the underlying business in coming quarterly reports. But even when we look at that return on assets, equity, total capital, and invested capital, very healthy with the amount of spending that Uber has done, especially over the past 36 months. Management has efficiently allocated capital to see the best returns on that capital. And you can see as of year end, you go December 2020 for that return on equity of negative 51.2%. Go to December 2025, you're at a 41.4% return on equity. Management has done a very good job of allocating capital efficiently. And we see that in these compounded annual growth rate numbers. Look at that revenue and sales growing on a 5-year compounded annual growth rate of 36.1%. You're seeing gross income rise as well, sales continuing to rise. Uber is continuing to expand and gain market share and becoming the dominant player in the space. So there's a few bullish points I want to touch on. First, I'll talk about the dual engines as Uber operates both the ride sharing and the food grocery delivery services, which gives it cross-platform efficiency. Delivery users convert into higher frequency rideshare users and vice versa. Along with that, the subscription ecosystem incentivizes higher spending and repeat transactions across both platforms, locking in user retention and lowering customer acquisition costs over time. We did see the strong financials that Uber has and the runway ahead for its future growth. Now, I keep talking about the autonomous vehicle aggregator that Uber wants to become. Rather than battling pure play AV providers and treating them as a threat, Uber is positioning itself as the marketplace layer through which autonomous fleets like Waymo and WeRide, for example, deploy and commercialize their robo-taxis. Global third-party autonomous vehicle partners benefit from Uber's massive real-time demand routing, balancing peak driver demand with robo-taxi supply without requiring Uber to take capital-intensive vehicle manufacturing onto its balance sheet. So those are the reasons why I personally believe Uber is a good company to buy in August of 2026. And the next company we'll get into is Alphabet.
We had a little demo issue. Let me try one more time. All right. Check my calendar and see if I'm free when she's coming to San Francisco this year. Let's see if the demo spirits are with us today. Nope. Uh-oh. Looks like they're not with us. All right. Let me try that one more time on another device.
So Alphabet has come a long way since that huge debacle in 2024 when they first released Gemini and had those demo problems. Since then, shares have appreciated over 150% from that point to their peak. We can see earnings per share continuing to double from this year to next. They are coming down slightly in 2027, which again, I do believe is very conservative. With all the spending, the nearly $200 billion of spending that Alphabet has been doing, I do believe that they're going to be able to realize more of that return than the street is anticipating, especially when you look back historically. Alphabet's management is very efficient allocators of capital, one of the best allocators in the world. Them and Meta, I would say, are the top two. And you see that when we look at that return on equity as well at 48.7%. Now, when we look at the underlying business itself, sales are growing 20.2% over the past year, continuing to grow. There's a huge backlog of over $400 billion in Google Cloud alone. That should continue to increase sales over the next 4 to 8 quarters. And when we look at those gross margins right now at almost 61%, being compressed only slightly to 55% to round up, that is very healthy. And we are seeing those margins continuing to expand on a 5-year trend. Like I mentioned, very efficient allocators of capital as well, with that return on equity at 48.7%. And when we look at that top right there, the valuation metrics are very cheap. On a trailing PE basis, you're looking at 17.9. On a forward PE basis, you're looking at 20.8. I will say that price of sales at 9.8 is more expensive than what we would like to see, but I do believe that premium is warranted on Alphabet shares with the very diverse business model and revenue streams that Alphabet has. And I'm not alone with that. When you look at the analyst price targets, there are 62 analysts who cover the name. Holds have come down recently. Sell ratings have come down recently. On average, analysts believe that shares will appreciate 21%. When we look at the downside of $340 per share, shares actually dip below that towards the beginning of August, I will say, but that does imply a decline of 4.45%. But when we look at the biggest bull, having a price target of $550, that does imply an almost 55% upside. So that risk reward, I believe, is warranted to enter the name as well. You are also seeing that divergence in that baby blue line, which is Alphabet share prices, to the analyst price target in the dotted line. And I do believe analysts are having to revise upward their price targets very soon. And when we look at Alphabet and compare it to the group as a whole, shares are actually trading very cheap. I will say Oracle is also a very good company. Apple is very smart in how they approach the AI rather than developing in-house. Partnering has been the way to go with Apple. IBM is having that put stop by the government as well with the quantum computing grants that they are receiving. Yet, with all that being said, Alphabet shares are still trading cheaper than the peer group on a trailing PE basis. Again, take a step back. Of those three companies, Alphabet, IBM, and Oracle, which one would you prefer to have? Which one is a sleep well at night investment? And I do believe Alphabet provides that for shareholders. And even that PEG ratio over the next 12 months for Alphabet at 2.3, I don't believe is expensive for the runway of growth that Alphabet shares have through the variety of their segments, whether it's Waymo, Gemini, DeepMind, Google Cloud, like I mentioned, that has a $400 billion plus backlog. That PEG ratio at 2.3 on a forward basis is very cheap. And we see these gross margins continuing to rise and trend upward over the past 5 years. You look at that December 2020 on a gross margin basis of 53.5% to year-end 2025, almost 60%. And you're seeing those net margins especially continuing to rise from 22.2% in December 2020 to almost 33% in December of 2025. Very healthy to see, and is quite remarkable considering input costs for many segments of Google's businesses have increased over the past 4 years. So to see those margins continuing to expand and should continue to expand as per management commentary as the most recent quarterly report is quite remarkable. And you can see the efficiency of management and the overall business of Alphabet Even when we look at that revenue per employee and net income per employee, exponentially rising over the past 6 years. And when we look at that return on equity, assets, total capital, and invested capital, going from a return on invested capital of 17.4 in December 2020, nearly doubling to 32% in December 2025, does indicate that management, even though they are spending big in all the right ways. And you're seeing that in the realization of those investments. When we look at the underlying business, these investments have allowed the 5 and 10-year CAGRs to be very healthy. Look at that, 17.2% on a 5-year CAGR for revenue for Alphabet, 18.5% on a 10-year CAGR. Very healthy gross margins, gross income, pre-tax income, all increasing and moving in the right direction. And even when we look at that earnings per share on a 5-year CAGR of almost 30% growth, 25% on a 10-year CAGR on a diluted earnings per share basis, this is a very healthy company, a growth company, yet one of the most valuable companies in the world that continues to impress each and every quarter, not only with their reported numbers, but also with the suite of Alphabet products and revenue streams. So just like we did earlier, I'm just going to touch on a few bullish points for Alphabet. I'll start with the dominance in Google search, which they maintain a 90% market share in the global search engine space. And this creates entrenched network effects. Google's end-to-end control over hardware, operating systems like Android, and software allows seamless integration of Gemini models, partnerships such as licensing AI models to Apple for iOS, like I mentioned earlier, and Siri integrations, further extends its reach. Also, Google's custom AI chips, TPUs, provide cost efficiency and speed advantages, reducing reliance on third-party silicon suppliers for its own data center workloads. And like I've been mentioning, with the $400 billion plus of backlog for Google Cloud services, Google Cloud alone continues to generate double-digit year-over-year revenue growth, turning into a core profitability driver alongside the mega ad business that Alphabet has been known for many, many years. Also, the AI enterprise adoption, demand for infrastructure and enterprise tools like Gemini Enterprise positions Google Cloud as a premier destination for enterprises deploying custom generative AI apps. And finally, the last company we'll touch on is Microsoft.
Gates was momentarily and understandably shaken, but he was not.
That is not the first cream pie that Bill Gates has given or received in his lifetime. But besides that, let's dive right into a few key items here for Microsoft. You can see over the next 2 years, earnings per share growing. This is a mature company, yet still has a great runway of growth. We talked about Google Cloud having a $400 billion backlog. Microsoft Azure, Microsoft's equivalent to Google Cloud, has an over $600 billion backlog. We can see sales growing over the past 12 months for Microsoft by almost 18%. When we look at some profitability metrics, you can see gross margins over the past 12 months, almost 68%. You can see a dip in the gross margins. That is because, like I mentioned in previous videos, Microsoft diverted a lot of their cloud compute capacity internally, which compressed margins as you're not able to sell externally to increase your margins and your revenues, especially with the cloud business being such a high margin area for Microsoft. Yet we see those net margins trending in the right direction and not being compressed as much as we see other companies going from a 68% gross margin over the past 12 months to net margins of 40.3%. We can see return on equity declining over the past 4 years, still at a healthy 34% return on equity. Over the past 12 months, Microsoft has been spending heavily, has been one of the biggest spenders in the hyperscaler space, yet they have a track record of delivering good returns on their capital. So investors should be patient in seeing the realization of these investments over the coming quarters. And I want to mention Microsoft has rallied significantly, going from sub 400 to north of 500 as of recording of this video. And yet you're seeing valuation metrics not screaming over valuation whatsoever. On a trailing PE basis, 28.2, on a forward PE basis of 25.2. Very healthy for the underlying business that Microsoft has and the runway of growth and trajectory of growth for Microsoft as a whole. Yet when we see those price to sales at 11.4, I will agree that is very expensive. And out of the three companies we saw today, in Uber, Alphabet, and now Microsoft, that is the highest price of sales. That premium, I do believe, is warranted. But let's see how this pans out. There are 55 analysts who cover Microsoft. Average price target of $564.11, implying an almost 13% upside from where shares traded today. The biggest bear has shares going to $400. I will mention at their 52-week low, shares were trading at $349 a share. Even the biggest bear thought that shares were too cheap, and I was making videos at the time. I do believe Microsoft is still cheap and still has a great runway to go. I will mention, you can see post earnings in that blue line shooting straight up, being very vertical post earnings. There has been a lag in that dotted line being increased. That is the analyst price targets. Analysts are slowly coming out to revise upward the price targets, and I do believe that trend will continue. Even the biggest bull in this case has shares appreciating 74%. Let's see, let's keep an eye out for more analyst price targets to come. And like we've done with all the companies, I didn't want to compare Microsoft and Alphabet in this video together, but when we compare Microsoft to IBM and Oracle like we did with Alphabet and even Apple in this case, shares are still trading cheaper than Apple. Even ServiceNow, I know that's a software company, a pure play software company. And sometimes if you ask ServiceNow what they do, they couldn't even tell you what they do. They're trading on a forward PE basis at a premium to Microsoft. Microsoft is trading at a premium to IBM and Oracle. Again, Oracle, I do believe it will be analyzed on a video on its own. I do believe Oracle is trading very cheap and the market is wrong in terms of its pricing and valuation of Oracle. But for the purpose of this video, we'll stick with Microsoft. And even Microsoft is trading at a slight premium with an overall better underlying business. And even that price of sales, it is the highest of the group, but that premium is warranted with the great underlying business that Microsoft has. Good things in life come at a price, and sometimes that price is warranted. We have seen a significant rally in shares of Microsoft. Yet that rally, I do believe, was just a re-rating and now gives Microsoft the true runway it should have had at the beginning of the year to grow, not only as a company, but its share price appreciation as well. And we see those profitability metrics growing. We look at gross margins being at a healthy almost 70%. Again, very heavy spending, but diverting a lot of that revenue internally on high margin businesses, which has compressed gross margins. But when we look at those pre-tax margins, operating margins, and even net margins, those have grown in a healthy pace. For a company that's been around for many decades, we are still seeing exceptional growth. And when we're looking at that return on equity, assets, total capital, and invested capital, having that return on equity, for example, at 34% is very healthy. All these metrics have come down just due to the heavy spending and the longer term cycle that Microsoft requires to realize a lot of these investments. But when we look at even operational efficiencies over the past 10 years, Microsoft has become a more efficient business. They are allocating capital to improve efficiencies, which in turn has led to revenues continuing to grow. And we can see that in these trends as well, 15% on a 5 and 10 year CAGR. Gross income's rising. Look at that 10-year compounded annual growth rate of almost 16%. We're looking at earnings per share. Just look at that on a 10-year CAGR, guys, on a recurring basis, almost 23%. On a diluted earnings per share basis, 24%. A 10-year compounded annual growth rate. This is a great company, a company that has survived many business cycles and has set itself up for future growth in the AI space, the compute space, the cloud space, and so forth. Alphabet has a lot of different revenue segments, but so does Microsoft as well. And finally, the last bullish point of this video, I will start with the dominance in cloud. Azure remains a primary growth engine, consistently outperforming broader industry growth rates. Higher enterprise demand for cloud migration and hybrid infrastructure gives Azure a massive runway. Through its deep partnerships and direct integrations With advanced frontier models, Microsoft embedded AI across its entire stack, from Azure AI infrastructure to consumer and business applications. And Microsoft's 365 Copilot monetizes AI directly at the seat level across enterprise productivity suites, driving higher average revenue per user across millions of existing corporate seats. Like we could see in that point below, and some viewers may use some of these programs like Word, Excel, PowerPoint, Outlook, and so forth. And these are entrenched in daily corporate operations, making switching costs prohibitively high for enterprises. And you can just take a look at that from a personal standpoint for the company you work for. How often do they change software and systems? And what is that appetite for them to do so? Really nil. So the switching costs are too high, and corporations as well don't really like to change things up once everything is already in place. There's no need to reinvent the wheel. And Microsoft's indispensable role in business software gives it an unmatched pricing power, allowing it to pass along price increases and upsell bundled services with minimal customer churn. And like we've said before, Alphabet has many different revenue streams. Microsoft has that as well. You can see in that breakdown in the bottom right snippet, especially after that Activision Blizzard acquisition, from gaming to enterprise software to cloud to personal applications to social media through LinkedIn. Microsoft has many different revenue streams that it can monetize on and is monetizing on for current and future growth. I'd like to thank you guys for making it to the end of the video. Truly does mean a lot to me if you can hit that like and subscribe button. And please stay tuned for the next video.